Welcome, traders. Today we're breaking down the basics of Forex, the foreign exchange market. Whether you've never opened a chart before or you've been confused by candles, by the end of this session you'll understand what Forex is, how the market moves, the difference between fundamentals and technicals, and how traders actually make decisions. Let's start simple and build up. 1. What is Forex? Forex, short for foreign exchange, is the global marketplace where one currency is exchanged for another. It's the biggest financial market in the world, larger than stocks, crypto, and commodities combined, with more than $6 trillion moving daily. When you trade Forex, you're not buying or selling a physical item. You're trading currencies in pairs. For example, euro to US dollar, pound sterling to Japanese yen, USD/ZAR. If you buy euro to US dollar, you're betting the euro will strengthen against the dollar. If you sell, you're expecting the dollar to gain strength. The market moves because of supply and demand, who wants a currency and who doesn't. 2. How currency pairs work? 1 minute. Every currency pair has two sides. Base currency, the first currency in the pair. Quote currency, the second one. So if euro to US dollar is at 1.0800, that means 1 euro equals 1.08 US dollars. If price goes up to 1.0900, it means the euro strengthened. If it goes down to 1.0700, the dollar gains strength. Your job as a trader is simple. Predict which direction the pair will move. 3. How Forex moves? Market structure, 1 minute. Forex doesn't move randomly. It moves in patterns. Uptrends, downtrends, ranging markets. Market structure is the backbone of price action. Higher highs and higher lows mean buyers are in control. Lower lows and lower highs mean sellers dominate. Once you understand this, you stop guessing and start reading price like a story. 3. How Forex moves? Market structure, 1 minute. Forex doesn't move randomly. It moves in patterns. Uptrends, downtrends, ranging markets. Market structure is the backbone of price action. Higher highs and higher lows mean buyers are in control. Lower lows and lower highs mean sellers dominate. Once you understand this, you stop guessing and start reading price like a story. 4. Fundamentals, 2 minutes. Now let's go deeper. Fundamental analysis is everything that affects a currency outside the chart. You're looking at the economy, politics, news, and global events. The biggest fundamental drivers. Interest rates. When a country increases rates, their currency usually strengthens. Traders love higher returns. Inflation reports, CPI. High inflation can weaken a currency unless the country plans to raise rates. Employment data, NFP for USD. Strong job numbers usually mean a strong economy and a stronger currency. GDP. Growth means confidence. Confidence attracts investors. Geopolitical events. Wars, elections, oil crises, they all shake the market. Fundamentals explain why the market is moving. Technicals help you see how it's moving. A strong trader uses both. 5. Technical analysis. Technical analysis is studying the chart to predict future price. Here are the core tools every beginner must understand. Candlesticks. Each candle tells a story. Who's in control? Buyers or sellers? Long wicks show rejection. Strong bodies show momentum. B. Support and resistance. Support equals price floor. Resistance equals price ceiling. The market reacts to these zones again and again. C. Trends. Trend lines help you identify direction. Trading with the trend is always safer than fighting it. D. Indicators, but don't rely on them. Beginners love indicators, but the truth is, price action is king. Indicators only confirm movement. The most useful ones. Moving average shows trend direction. RSI shows overbought/oversold. MACD shows momentum. Use indicators like seasoning, not the whole meal. 6. Risk management. Here's the hard truth. You can be a great analyst, but without risk management, you'll blow your account. Key rules. Never risk more than 1 to 2% per trade. Always use a stop loss. Only trade with money you can afford to lose. Don't revenge trade. Don't over-leverage. The goal is not to win big. It's to stay in the game. 7. Trader psychology, 45 seconds. Your mind is your biggest weapon and your biggest enemy. Fear, greed, impatience, these kill more accounts than bad signals. You must learn to wait for setups, accept losses, stick to your plan. Stay neutral, not emotional. A disciplined trader beats a smart trader. 8. How to start trading. To begin your Forex journey, choose a trusted broker. Start with a demo account. Learn one strategy and master it. Keep a trading journal. Move to a small real account once you're consistent. Consistency beats excitement. Slow growth beats gambling. Closing. And that's your foundation. You now understand what Forex is, how the market moves, the difference between fundamentals and technicals, and the importance of psychology and risk management. This is just the beginning, but with these basics, you're already ahead of most beginners. Jesse Livermore said, "Remember, in Forex, you don't need to predict everything, you just need to react correctly. Trade smart, stay disciplined, and your journey begins now."